Hi everyone, Nick here. I see a lot of YouTubers promoting Robo-Advisors. While they could be a decent option, I just don't see much depth in their analysis. I feel obligated to make a video to help you make a more informed decision. I will tear past the marketing of Robo-Advisors and shine a light on many details noob investors overlook. We will discuss why Robo-Advisors are often not as simple as they might seem, why one of their main benefits is actually irrelevant to many investors, and how they could end up costing you over $100,000 in extra fees. At the end, we'll look at a couple great alternatives, including my portfolio. If you're new to my channel is about helping you make money, invest, and achieve financial independence. Since I might be saving you thousands of dollars in this video, I ask that you smash the like button. Smashing the like button helps support free financial education, as YouTube is more likely to share it with more people. The primary sales pitch of Robo-Advisors is to make investing easy and cheaper than the traditional financial advisor. They automate your investments so you don't have to figure out how to diversify, rebalance, or save money on taxes. You can start with as little as a few $100s. It's very easy. If you don't know how to get started, you're caught in analysis paralysis, or you just want to set it and forget it investment, Robo-Advisor could be a great option for you. This is the primary sales pitch, little simplified, but let's dig into why a Robo-Advisor might not actually be a great option. We're going to start with tax loss harvesting. This is one of the main benefits advertised by Robo-Advisors. They save you a bunch of money on taxes. This sounds great. It sounds a little complex, but it's actually pretty simple. Let's look at an example. Let's say you were to buy $1,000 of Tesla stock today, and next week it were to drop to $800. You could book that $200 loss, and the IRS will let you subtract that from your income for the year. If you're in the 25% tax bracket, this could mean $50 in tax savings. However, there are two catches. First is if you were to rebuy Tesla within 30 days, you cannot subtract it from your income. It's called a wash sale. Second, you can only subtract up to $3,000 of losses from your ordinary income every year. If you do happen to accumulate more losses, you have to spread it out over multiple years. This is tax loss harvesting in a nutshell. While nobody wants to lose money on their investments, if you're making investments monthly, you're inevitably going to have a month where your investments go down shortly after you purchase them. This is where the Robo-Advisors come in, where they automate the tax loss harvesting for you. This sounds great. Sign me up. Hold on a second. There's actually two problems with this. First, most investors would be better served by investing in retirement accounts like the 401k or the IRA. These have special tax treatment where the government allows you to defer or avoid taxes altogether. In such accounts, tax loss harvesting is irrelevant. The contribution limit on these accounts can be over $60,000 for each person, or over $130,000 for a couple. Most people are not maxing out these accounts. So it'd be foolish for most people to go invest in an account where tax loss harvesting was applicable. You'd rather just max out the tax advantaged accounts, because you're generally going to get a better tax advantage from them than tax loss harvesting. Now maybe you invest a lot, you max these out, or you have a reason for not maxing them out, and you want to be able to tax loss harvest. Well, there's another consideration to be aware of. If you do have a 401k or IRA with some money in it, you have to avoid the wash sale. The Robo-Advisor is selling an asset and tax loss harvesting it, but your IRA or 401k has an automatic dividend reinvestment for a similar enough fund that can create a wash sale. You might actually be unaware of it. Maybe you even just get surprised in an audit from the IRS where they discover this and you get hit with a tax penalty. You have to pay attention and make sure your Robo-Advisor and retirement accounts don't have these types of conflicts. Some Robo-Advisors might let you set this up where it'll avoid certain funds, but it's extra hassle you have to deal with. But I thought the whole point of a robo-advisor was to just set it and forget it, investing made simple. This doesn't sound that simple. It's actually a bit of extra complexity. And that brings us to the next point. Robo-advisors cannot eliminate all complexity from your portfolio. They can shield you from some complexity, but they can't handle all of it. For instance, if you are going to invest in a retirement account and get that free match your employer gives you, it's probably separate from the robo-advisor. You still need a way to manage your overall portfolio. The robo-advisor just can't eliminate managing your entire portfolio. You still need to pay attention to this or hire somebody who's going to oversee all of your accounts. Another thing the robo-advisor doesn't eliminate is called the glide path. When you're young, you might want very risky investments, like almost 100% stocks. But as you approach retirement, you want to lower the risk in your portfolio. This is called a glide path. Whereas you age, you add more bonds to your portfolio and reduce the amount of stocks. This way, when you go to retire, you don't have the risk of losing half of your portfolio in a stock market crash just as you need to start withdrawing and paying your bills. Now, we saw that robo-advisors can't eliminate all complexity from your portfolio. In some cases, they actually increase the complexity in your portfolio. This is because robo-advisors often invest in dozens of ETFs or sometimes even hundreds of individual stocks. One of the reasons for doing this is to create more opportunities for tax loss harvesting. This is because when you own more stocks or more ETFs, there's the chance that some are going to be going down. While you could invest in just a single ETF that owns the entire stock market, robo-advisors will slice that up for this tax loss harvest opportunity. However, as we saw, it's not actually advantageous for many investors, but it adds complexity to your portfolio whether you need it or not. I'm going to share a story I read on the Bogleheads forum. I will link this in the description below. There was somebody who decided to leave their robo-advisor, transfer the assets to Vanguard. They decided they just wanted a simpler portfolio that they would manage themselves. After dealing with what they described as an extremely difficult process to transfer the assets from the robo-advisor to Vanguard, they were left with a portfolio that had over 120 holdings. And it had accumulated over $150,000 in taxable gains. They're at the point where they had to stick with a complex portfolio to avoid the taxes, or sell the portfolio to reduce it to a less complex portfolio and pay taxes on the gains. This is a poor situation to be in. Could actually lead many people to just decide, I'm going to stick with the robo-advisor. I have this complex portfolio with a bunch of taxes if I want to switch. So we'll just let them deal with it. It'd be difficult to find someone else who wants to take over managing a 120 holding portfolio. Actually, you kind of need an investment software to do that. This gets us to the next point, which is lock-in. The more money you invest with the robo-advisor, the longer you're there, build up capital gains, the less likely you are to switch. In addition to this, many people are talking about how robo-advisors are under pressure from their venture capitalists. The robo-advisors didn't grow quite as much as the venture capitalists expected, and now they're under pressure to raise revenue. So they're finding ways to extract more money from their customers. In 2017, one of the most popular robo-advisors increased the fees they charge their customers by 66%. In 2018, another popular robo-advisor decided they were going to roll out a new investment product. This investment product was a bit different from what they had previously sold their customers. It had 5 times higher fees, and it was an active investing product instead of the passive investing products their customers originally purchased. Now, this is where it gets questionable. The way they decided to roll this out and get new customers was to say, hey, we have all these people and all these portfolios. Let's just add it to their portfolios. We're going to make it a default 20% part of their portfolio. Granted, we'll give them the option to opt out, but by default, we're just going to opt them in unless they tell us, no, don't do that. And that's what they did. Many people are probably paying much higher fees for this active investing product. We all know active investing products have roughly an 80% chance to underperform the passive index. And this product was no different. Since it was rolled out in 2018, I was just looking at it, it's actually lost money since it was rolled out. This is in a time frame where stocks have produced positive returns for investors, bonds have produced positive returns for investors, but this new product lost money for the investors. In my opinion, this was a bait and switch where people signed up and then later their fees were just raised, or other people signed up for a passive investment strategy. It was as if an active investment strategy was snuck into their portfolio unless they were reading their email and said, hold on, don't do that. This brings us to the next point, which is fees. I'm all for paying people if they're providing me good value. So let's look at the fees for a Robo-Advisor and determine if it's worth the value. Most Robo-Advisors charge anywhere from 0.25% to 0.5% annual fee. This is on top of the fee for the ETFs in which they invest your money. So you might pay a weighted average of 0.1% for the ETFs and then another 0.25% to 0.5% for the Robo-Advisor. Well, this may seem like a small amount. It can add up to a lot over a long term. For instance, my portfolio has a 0.05% fee. That's 0.0005%. The Robo-Advisor fee of say 0.35 to 0.5, the Robo-Advisor is 7 to 10 times more than my portfolio. Does it deliver 7 to 10 times more value? We'll look at that in a few minutes. But first, let's look at the long-term impact of these fees on a portfolio. I'm going to use an investment calculator called dinkytown.net. It's kind of an interesting name. What this calculator allows us to do is compare the effect of fees on a portfolio. We're going to take my portfolio's fees, which are 0.05%, compare them to two Robo-Advisor fees at 0.35 and 0.5. That's 7 to 10 times as much as my portfolio. We're going to see the effect of those fees on the portfolio over 40 years. We're going to use the same scenario. An investor that starts with no money, they invest $500 per month for 40 years, and they get the same return. For the return, we're going to use the inflation-adjusted return of the S&P 500, which is 7.2%. So let's look at the results. The results are pretty staggering. Fee 1 is my portfolio. You would have invested $240,000, and you would end up with $1.292 million after 40 years. With fee 2, which is like the lower end of the Robo-Advisors, 0.35%, you would end up with $1.194 million, which is about $100,000 less than my portfolio. And then with fee 3, which is the higher end of the Robo-Advisors, 0.5%, you would only end up with $1.148 million, which is about $150,000 less than my portfolio, maybe more like $143,000. The overall impact of this on your portfolio over 40 years is the 0.35% fee decreased your return by 10%, and the 0.5% fee decreased it by 15%. This is actually a pretty big impact on your portfolio. While a 0.5% fee seems small, it is 10 times as much as the fee I'm paying in my portfolio. Even the 7 times fee is still pretty high. They have $100,000 to $150,000 inflation-adjusted drag on your portfolio. This could buy you a pretty nice house in many parts of the country. So what value are the Robo-Advisors providing you? Are they providing you more than a house in value? I don't know. That's a good question. If you get enough tax loss harvesting over 40 years, they might provide that value. How have they performed recently? Since they started, have they provided more value to their investors with higher performance from their sophisticated investment algorithms? Let's go take a look at the historical performance of the Robo-Advisors. Before we start looking at the historical performance, I want to caution you. We can't look at past performance and assume that that's going to be reflected in the future. The future could be entirely different from the past when it comes to investing. The best we can do is look at how sound the investment strategy is. And we can use past performance as like a gauge to see how did this strategy work out in the past. In this case, we're going to compare a couple strategies. My portfolio is a strategy that's pretty similar to Robo-Advisors. I don't do as much tax loss harvesting, but I invest in the total stock market. And I invest in nearly every country in the world. It's a very well diversified portfolio. It's pretty similar to these Robo-Advisor portfolios. They might have a little bit of a different exposure to, say, real estate or smaller companies, but overall, the 80 to 90% is the same. So let's compare the performance of my portfolio compared to two Robo-Advisor portfolios. It's actually a little difficult for me to find details of the Robo-Advisor portfolios. I found a couple blogs where the authors were sharing their portfolios from a Robo-Advisor. Another challenge is a lot of the ETFs used by these Robo-Advisors are pretty new, so you can't get a lot of historical performance information from them. In order to make up for this, I made some minor tweaks to the portfolios I found on the blog. And the tweaks that I made were very small. Like, let's say there was a new municipal bond ETF that I can't get a lot of past performance for. I found another municipal bond ETF that is older. They should provide roughly equivalent performance since they track basically the same benchmark. So I swapped these out and I was able to get performance back to 2008. I plugged these portfolios into a tool called Portfolio Visualizer. This lets us backtest the portfolio to see how it's performed. In this case, since 2008, since that was about the history I could get on some of these funds. ETF investing is still pretty new for some of the sectors. I actually spent a fair amount of time putting this together. Let's look at the results. In this comparison, my portfolio and the Robo portfolios are pretty simple. One of the Robo portfolios was 100% stocks, the other was 95% stocks, 5% bonds. And then for my portfolio, I just adjusted it to 95% stocks, 5% bonds, just so there was a good comparison with these two portfolios. So we ran the comparison starting with $5,000 in 2008. And as you can see, my portfolio provided a 7.33% yearly return compared to Robo number 1, which only provided 5.39%, and Robo number 2, which only provided 6.17%. So we're looking at a performance difference of 1 to 2%, these Robo portfolios versus mine. And again, my portfolio is a bit different, but the overall strategy of my portfolio is not that far off the Robo portfolios. Let's look at the annual returns. You can see that in most years, my portfolio, the blue line, has better performance, and that's reflected in the overall return. There are definitely some years where it's about equal or the Robo portfolios outperformed a bit. However, in aggregate, my portfolio outperformed both of these by 1 to 2% per year. This can add up to significant amounts of money over time. We saw the difference between 0.05 and 0.5%. Imagine the difference of 1 or 2%. I just want to remind you, we can't count on past performance to be indicative of future performance. There is no guarantee when it comes to investing. We can only use this as one indicator. So we have to factor this into everything we learned. So let's recap what we've learned so far. We saw that tax loss harvesting is actually irrelevant for many investors who would be better served by investing in tax-advantaged accounts. We also saw that Robo-Advisors can't eliminate all complexity from a portfolio. You still need to worry about your overall portfolio, you need to be concerned about your glide path, you need to make sure that you don't have conflicts with the tax loss harvesting from the Robo-Advisor. In some cases, they can add complexity by constructing a portfolio that would be almost impossible for you to ever take over and manage yourself or find someone else other than a computer to manage it for you. We saw the effect of fees can be massive over the period of 40 years, We also saw a bit of underperformance. Then we saw that dreaded lock-in, where investors were basically bait and switched, buying one thing and then getting the fees raised or investment products swapped on them. Now, I don't want you to get the idea that I'm just trashing robo-advisors. I still think they could be a decent option for some people. However, we see a lot of hype, people talking about how great the robo-advisors are. I just wanted to balance it out so that you could make a more informed decision. Now let's look at some alternative portfolios, which I think are great options and are still pretty simple portfolios, easy to manage. The first alternative, which I think is best considering it is my portfolio, is the 3-fund portfolio. This is composed of 3 index funds: the total US stock index fund, the total international stock index fund, and the total US bond index fund. With just these 3 funds, while it may sound too simple, it is diversified globally across 10,000 stocks in nearly every country in the world, and it holds thousands of bonds in the US. Kind of an interesting story. When I was traveling in India, I was on a tour, and the tour took us to a remote desert near the border of Pakistan. We were maybe 100 miles from the nearest city, in the middle of nowhere. We're driving along the highway, and we're passing a wind farm. I looked up who owns that wind farm, and it's a company in the total international stock index. When you're invested in these funds, you can go almost anywhere in the world and see your money at work with just 3 funds. It's crazy. Another great thing about this portfolio is it allows for optimizing for tax efficiency. I'll actually hold different funds in, say, my 401k or my Roth IRA. It lets me optimize a bit for taxes. I actually made a couple videos. One of them was on the 3-fund portfolio, and I'll link it right up here. You should check that out just to learn the basics of asset allocation and how to construct this portfolio. I also made another video on tax-efficient asset allocation that teaches you how you can spread these funds across different types of investment accounts, and I'll link that up here. I made a third video about the different types of investment accounts that are available and why you would want to invest in one versus the other. I will also link that right up here. You might be saying, Nick, I still want set it and forget it. This 3-fund portfolio sounds fairly simple, but it still sounds like I have to learn a lot to be able to manage it myself. Now, we do have another option, and that is the Target Retirement Index Fund. I briefly talked about this in the asset allocation video where I talked about the 3-fund portfolio. The way that these funds work is they're basically a 4-fund portfolio. They're the 3-fund portfolio plus an international bond index. Now this provides you the same global exposure, even a little more diversification with international bonds. The great thing about this is it does it for you, automatically rebalances, and even better, it manages the glide path. As you approach retirement, they'll increase the amount of bonds in the portfolio and reduce the amount of stocks. You can literally invest in this one fund until you die, and that is a great option. They will manage everything for you. This is a true set it and forget it. The fees for the Target Retirement Index funds at Vanguard are 0.15%. The Robo-Advisors are still 2 to 3 times this fee, and they have comparable performance to my portfolio since they're almost identical. Now there is one other option that's kind of like a set it and forget it that could allow you to use the 3-fund portfolio. And that's coming from a company called M1 Finance. M1 Finance lets you create something they call pies. This basically lets you take your portfolio and slice it up. Looks like a pie. So you could say I want half of my portfolio invested in this ETF, 20% of my portfolio in this ETF, and 30% of my portfolio in this other ETF. And then it's basically on autopilot. You just send M1 money and they automatically invest it across your pie. They'll put the right amount into each fund. You don't have to do it yourself. And then they even have a button that you can click and say rebalance the portfolio. So you could do that once per year. And they'll actually make your contributions to like rebalance. So like one fund's gone down, they'll invest a little more money into that fund with your next contribution to bring it back into balance with your pie. So I've actually gone and put my portfolio into an M1 pie, which I will share in the link below. I'll also put a referral link to M1 Finance below. You get an extra benefit of getting $10 once you fund the account. And then for referring you, I get $10, which I'll use to reinvest into this channel to produce higher quality content. While I think M1 is a great option, you should also consider Vanguard and Fidelity. For instance, Fidelity actually allows you to invest as little as $1 in their index funds. It's a great way for people to get started. You can construct a 3-fund portfolio over there. Thanks for watching, everyone. A robo-advisor could still be a great option for you. I just wanted to help you make a more informed decision. I hope this video helps you do that. Please comment below and tell us what you think about robo-advisors. And if you got value from this video, please share it with your friends, then smash the like button and subscribe. Later.